Thank you. How useful is the financial reporting in the general daily press to you, and how useful should it be to investors in general?
Okay. It has improved dramatically, not just in the press, but also company reporting. 10 years ago, companies didn't have interim balance sheets.
स्टॉक मार्केट रिलेटेड इंटरव्यू वीडियो पाने के लिए मेरे चैनल को सब्सक्राइब करें और बेल आइकन को दबा दें.
It's hard to imagine. They only gave their balance sheet to you once a year. Now they show you quarterly what's happening in their inventories, what's happening in receivables. In the major newspapers, they'll even show types of funds. They're now, I think there's 2,500 companies in the New York Stock Exchange. There's over 5,000 different mutual funds. So there's twice as many mutual funds as there are stocks. At least in the paper day, explains what kind of fund this fund is. So I think reporting has improved. They report earnings. But again, I think if you own auto stocks, you shouldn't be reading the financial part of the newspaper. On Wednesday, the local newspaper, Tuesday some places, or on Saturday, they have a whole 4 pages on automobiles. And they talk about new models. And they say this one stinks and this one's outstanding. They really, if you own auto stocks, that's the part of the newspaper you should be in. You shouldn't be calling your broker 4 times a day to get stock quotes. It doesn't work. Getting up in the morning to look to see how your stock did yesterday is not useful. All this stuff is just a waste of time. If you're adding up how much your stocks are worth, absolute waste of time. You should be looking at the company when you get the quarterly reports. You should be, if you're at the mall, imagine if you were in the retailing industry, or if you're in the restaurant industry, you would have seen Taco Bell, you would have seen McDonald's, you would have seen Toys R Us. I mean, you would have seen all these companies do terrifically well. You would have seen Bombay, you would have seen Tandy with Radio Shack, and you would have seen Radio Shack roll across the country, and pretty soon there were 25 Radio Shacks in every major city, and you said, there's not much room for them to go. But they had a 20-year great run. That's what you're dealing with. You're not dealing with the minutia of today. You're dealing, what's this company doing 2 years, 3 years, 4 years, 5 years from now? And if you're dealing with a cyclical and business is turning around, you wait for signs that business is slowing down. And when you see it, you move on to something else.
Are you concerned about the volatility in the financial markets today? Do you think something needs to be done to reduce it?
I love volatility. I remember when in 1972 the market went from down dramatically, and Taco Bell went from 14 to 1. They had no debt. They never had a restaurant close, and I started buying at 7, but I kept on to it, and it went to 1. And it was the largest position in Magellan in 1978 when it was bought out by $42 by Pepsi-Cola. And I think it would have gone to 400 if they didn't buy it out. I think volatility is terrific. I think these callers are very important. I don't think the market going up 80 points one day and down 80 the next is a good thing for the public. I think that's not a very good thing. But I think all these callers and all these other things, to keep the volatility down each day is important. But the market's going to go up and down. Human nature hasn't changed a lot in 25,000 years. And some event will come out of left field, and the market will go down or the market will go up. So volatility will occur, and markets will continue to have these ups and downs. I think that's a great opportunity if people can understand what they own. If they don't understand what they own, they can own mutual funds, try and figure out what mutual funds they own, and keep adding to it. Basically, corporate profits have grown about 8% a year historically. So corporate profits double about every 9 years. The stock market ought to double about every 9 years. So I think the next market's about 3,800 today, 3,700. I'm pretty convinced the next 3,800 points will be up. It won't be down. The next 500 points, the next 600 points, I don't know which way they're going. So the market ought to double in the next 8 or 9 years. It ought to double again in the 8 or 9 years after that. Because profits will go up 8% a year, and stocks will follow. That's all there is to it.
We're in the month of October. Beware of the month of October, the witching month for the stock market. What do you see as the outlook for this month, and when do you think the Dow will hit 4,000?
Okay. October has always been a special month. I remember in 1987, I was very, I was very convinced the market was not in trouble, and I didn't worry about things. And Carol and I had planned this great golf vacation to Ireland, and we were going to visit one course and stay at a little house and visit another, go all along the west coast of Ireland and play golf. And we left on a Thursday night, and the market went down 55 points that day. It which was not too good. And the next day we got to Ireland, because of the time difference, we'd completed our day, and I got back to the hotel and I called in. The market had gone down 112 on Friday. And I said to Carolyn, you know, I think if the market goes down on Monday, you know, we're going to have to go back. And so we stayed there for the weekend. And on Monday, the market went down 508 points, and my fund went from, I think, 12 billion to 8 billion. And that gets your attention, you know, in two working days. You know, I said, at the end of this week, I'd be have no fund. Now, there wasn't a lot I could do. I mean, here I was on Monday, because the market didn't open, you know, by 12 o'clock it was, in Ireland, it was still 7 o'clock in New York. So we did spend that day, and we played around golf in the morning, and then we went somewhere and sort of watched the market deteriorate. And I did come back. There wasn't nothing I could do. I mean, just nothing I could do about it. But I think my shareholders, they called up and they said, well, what's Lynch doing? They said, well, he's on the 6th hole, and he's, you know, he's even par up to now, but he's in a trap. This could be, you know, this could be a triple bogey here. This could be a big inning. And I don't think that's exactly what they want to hear. So I could do something about this damn thing. So I came back home and suffered with everybody else. And fortunately, I was very consistent. The market went down when I ran Magellan. On 13 years, the market went down 9 times, and every time the market went down, Magellan went down. I was 9 for 9, and you know, because it's very important. This is another one of these numbers you ought to write down. If you put $1,000 in a stock, all you can lose is 1,000. I've done that several times, and but if you're right, you can make 5,000, 10,000, 20,000. So this business, you don't have to be right 1 or 2 times. You can be right 1 out of 4. It's a long time. The times you're right, you know the company's doing well, you know they're doing a great job, and you add to it, or at least you don't sell it, which is a terrible tragedy. So you can make more money on the upside. So I just wrote those out, and I will now flip a coin to tell you where the market will go to 4,000 this year or next year. Heads means it goes up. It's a 2-headed coin. The market will go up in the next year. That's it. That's all I ever know about the stock market.
Well, we have, as you can imagine, many questions about where people should put their money. I'm going to divide it into 2 parts, if you can address it. This questioner intends to put $1,000 yearly into my 4-year-old daughter's education fund. Where should I put it? Invested 1. The other just covers everybody else. What are some of your current market favorites, and why?
Well, on the first one, and this is important whether you're investing for a 4-year-old, a 14-year-old, or a 74-year-old. You have to say, what am I going to do when the market goes down? Because I've had audiences like this, larger audiences, and I'll say, how many people in the room are short-term investors? I've never had anybody ever raise their hand. I mean, everybody in the world is a long-term investor until the market goes down. And like in 90, I remember 1990. 1990 was so much scarier than 87. 87, the market just fell down, and you call up companies that our business is terrific. We're about to announce a stock buyback, or we're already buying back our stock. Business is great, and we can't figure this out. But in 1990, you had Kuwait invaded. You had the banking system really on the ropes. I mean, really close. You called up a company and said the business was slowing down. We sent 500,000 troops to Saudi, and we were about to fight what people thought was the remember, it was the 4th largest army in the world, and they were the toughest army in the world, and this was going to be a terrible war, and that we ought to sit them out. Remember the theory, the big theory, there's a lot of people in this city saying, we ought to wait them out. You know, we'd still be waiting there at 120 degrees with our 500,000 people. I mean, I think Bush made an incredibly brave decision on the information he was getting to go in there and knock them out, or we'd still be there. But that was an ugly time, and that was very scary, and the public stood, some people learned from 87, and they stood throughout that and said, I'm confident about the next 5, 10, 15 years of this country, and they hung in there. So I would say if you want to buy a small growth fund, or you want to buy a balanced fund that's part bonds and part stocks, you put so much money in, put more in every year, you'll be very pleased in 10, 20, 30 years. Stocks will beat the hell out of money markets. They can beat the hell out of bonds. No group of, you think of it, any corporations, McDonald's, any of these great companies, Marriott, you name it, they've never got together and said, geez, we're really doing well. Why don't we raise the coupon on our bonds? Those bondholders have been really loyal. We've been given 8%. Why don't we raise it to 9%? But companies like automatic data processing, they do payroll. It's an amazing prosaic company. 32 years of higher earnings. 32 years of double-digit earnings growth. We've had recessions, we've had wars, we've had changes in Congress, changes in the Supreme Court. 32 years of up earnings. So, that's what you're relying on. Johnson & Johnson, 30 years of up earnings. These are General Parts, 42 years of up earnings. Emerson Electric, 38 years of up earnings. You don't see companies like this in other parts of the world. So I think that's what you buy when you buy a fund. You're buying a bunch of good companies. And the second question was what again?
Just your...
the stocks. I think the financial area has been hurt heavily in the stock market. I think that's an attractive area. Stocks like Chemical or Travelers or Citicorp or Bank of Boston or Fleet or Shawmut, Fannie Mae, Freddie Mac. These stocks have all come down. Their business is terrific. They've improved their balance sheets. They're selling at multiples half or one-third lower than the general market. I think the cyclicals. I think we have a chance for the cyclicals for the first time in a long time. The steels, the papers, the aluminums, the chemicals. It's their turn to come to the plate. And I think there's going to be a good time the next... we seem to have an economy recovering in Latin America. Brazil is turning around. These are facts again. When you hear these facts, these countries are really... India, I've visited India. Things are really improving in India. Europe had the worst recession since the Depression. There's 18 million people out of work. 18 million people out of work in Western Europe right now. And the economy's starting to slowly turn. Japan has bottomed. So I think you're going to see a demand... And commodity prices have been, aluminum prices got to 30-year low. Now ingot has almost doubled. You're going to see the same thing with linerboard. So you're going to see a very good time for cyclical stocks. And I think the auto stocks are also extremely cheap at 4 or 5 times earnings. I think the economy's going to be, my opinion, from the companies I talk to, in the business I look at, things are not off trend line. These are not extraordinary times. Housing is very affordable. It's not as affordable as it was 2 years ago, but on a 20-year basis, housing is very affordable. Automobiles are very affordable. Consumer durables are very affordable. I think people are going to, and we've added, as you know, I still don't understand when we hear the job growth. We've added, in the recession, we lost 1.8 million jobs, and now we've added back 5.8 million, 4.5 million in the last 19 months. So we lost 1.8, and we've added 5.8 back. We're 4 million to the good. Tough part of it is we dropped about 600,000 manufacturing jobs, and we've only brought back 100,000 manufacturing jobs. But there are a lot more people working, and I think that trend's going to continue. And in the decade of the 80s, I think this is key. The decade of the 80s, this is what you hear from the press, this is what you hear from TV. In the decade of the 80s, the 500 largest companies eliminated 3 million jobs. 3 million jobs. But there was 2.1 million businesses started in the 1980s. And if they just have 10 people each, that's 21 million jobs. It's an incredible job machine we have in America. So that's what happened in the 80s. These 2.1 million businesses created all the jobs. And the decade of the 90s, the top 500 companies are going to eliminate another 3 million people. And all you ever hear about is Company X lays off 5,000 people in Hartford, and Company Y lays off 5,000 people in Rochester, and somebody doesn't buy a sofa in Scottsdale, Arizona, because they're reading their newspaper about another layoff in the Northeast. That's the nature. These companies have to do it to stay competitive. That's our business. And we've had, in the last 2.5 years, been a phenomenal, this has been a great thing for our country. We've had 1,750 companies come public. They've raised over $100 billion. There's only 2,500 companies in your stock exchange. 1,750 companies is a lot. They're going to put this into research and development. They're going to put it into more plant, more efficient equipment. This is a fantastic thing for these companies. So I think the situation is excellent. The banking system, for the first time since the early 50s, a lot of people follow the banking industry. The banking system today has more investments on the left side of the balance sheet. You talk about the governments they own, the mortgage-backed securities they own, than they have loans. First time ever since 1951. And they're only making 50, 20, 30 basis points. They said, love to make loans. The banking system has the highest equity to assets in 45 years. The banking system is ready to go. There's lots of liquidity around. I don't know why people are so depressed about people getting hired all the time. I can't quite figure this out. I don't know. I have never met a banker, And anybody in business that likes recessions. I've yet to find these people, you know. So I think it's very good the economy's doing well.
Well, speaking of banks, are you concerned about banks being allowed to offer mutual funds and the confusion that creates among investors over whether bank deposits are insured or not insured, or how much is insured, or the whole question of deregulation?
Okay. No, I think it's very positive banks are be allowed to sell mutual funds, because they'll probably sell a lot of Fidelity mutual funds. That's very important. No, but seriously, I think it's very important that people understand when they own a bond fund that bonds can go up and down. Bonds are just about as volatile as stocks. And if they own a 30-year bond fund, that you can lose 25, 30% of your money very fast, even though they're government bonds. People have to understand this. There's an incredible rate of illiteracy in our public, and all they ever hear about is what happened today to Bristol Myers going up $2 or $3, what happened to Dow Jones. They don't get to learn anything about America. And people at some point in their career are presented, they're near retirement, they're given $450,000, $500,000 because it's an early retirement. They have no experience. They don't know what a bond is. They don't know what stocks are. They have to make a decision in 30 or 60 days or they have a big tax consequence. These people have had no experience learning about the stock market. It's a tragedy. So I think anything we can do to educate the public, if you can convince people, if they understand the volatility of the stock market, I'm not saying anybody should buy a stock. I'm just saying if you purchase a stock, you ought to do certain things. If you purchase a stock and do certain things, you will do better. If you're not ready to do those things, you should keep your money in the bank. Keep your money in a money market fund. Some people aren't willing to do the homework. They don't have the stomach for it. They should stay out. They're not doing anybody any good by taking half their life savings and putting in the stock market. Or they've been lucky enough to save $50,000 or $60,000 to send their kids to college, and one's going to start in a year, and they're going to take all that money and put it in an equity mutual fund with a one-year horizon. That's doing no one any good. So I think the more, whether it's the banks that explain it, the brokers that explain it, anybody that does, and we're working on this at the SEC is working very hard on this to explain to people the nature of these products. If they understand them, they'll do better with it. More information, the merrier. Fidelity's launching a major study. It'll be out the end of this year on retirement. We've interviewed over 1,600 people, over 300 experts. We're going to put a major study on trying to explain to people about nature of retirement and how they can best understand how they should invest their assets. We're not going to mention Fidelity at all, of course. It may be subliminal in it, but we're trying to help. And the more we can do this, and there's been an incredible push by the SEC to do this, and I think it's a very positive element.
A couple of questions about that. What do you think of the SEC's proposal to require mutual funds to adopt a quantitative rating scale for riskiness, number one? And what effect do you feel that the new shareholder rights proposals for more open disclosure and communication are having on companies and the markets?
Okay. On the second one, I'm not too familiar with the first one. On the second one, I think you have to be careful in crossing the bridge on how much we get involved in managing companies. I think there should be disclosure of what people are getting paid. There should be disclosure of how many shares they own. But I don't think we should be deciding whether they should make this acquisition or whether they should expand this plant. When you get too involved in running a company, it's very complex. And a lot of great companies have made a lot of decisions you haven't heard about because they decided not to do something. Some of the best decisions they didn't do was to not do something. And if they're under all this pressure from shareholders of what to do and what not to do, they're going to take their eye off the ball, and they're not going to be able to run the business. And companies are doing well because the companies do well, look out 5, 6, 7 years, and some of the decisions they make may not be the right thing for the next year. The more and more we concentrate on what they're doing and we keep commenting on as outsiders, it's going to be run by an enormous committee, and we'll get committee results. So I don't think that's going to help anybody. But disclosure of relevant facts, of how many options people have, or the options at the market, what they're being paid, I think that's important, how many shares they own, what the company's doing. I think they used to not have a letter. I mean, it's not that recently that you have comments by the chief executive at the stop and hand report. They never used to make that. There's a letter saying what happened. I mean, it really is a very valuable piece of information. You don't realize this company spent a lot of time on this. This is a very serious document. I think it's very helpful to shareholders. The quarterly shareholder reports are excellent. And also, I've stressed everybody in America can get a hold of a company. It's not Fidelity and Putnam and Dreyfus. You can get a hold of a company if you own 100 shares. You can call a company, somebody will talk to you about it. Then people don't take advantage of that. These companies are willing to talk. On this quantitative and qualitative risk ratings, I think if it could be done, I think it might be possible. I'm a little confused on it. I'm not that up to date on it. But I think people should understand, that certain stock funds, emerging growth funds that invest in companies that have 50 million or sales and very small are much more volatile than when you're buying major quality blue chip growth companies, and that long-term bonds are more valuable than medium-term bonds, which are more volatile than one-year bonds. I think these are things that should be explained to people. People should get a menu like you get at Howard Johnson's.
Well, before we run out of time, and for Mr. Johnson's benefit, several people in the audience ask, how do you view Fannie Mae's stock and options today?
Okay. Well, I think I'd broaden it to Freddie Mac, too. I think both of these companies, have a great business. And I always look at the stock market, I think of it more, if people study chess, this would be not a good game to study for the stock market. Because in chess, an outstanding player will beat a good player 1,000 times in a row. Everything's in front of you, all the moves are known, it's all technique. In poker or in bridge, there's a lot of uncertainties, there's a lot of things you don't know. You can play a hand exactly right and lose. You say, but I played it right, if I do it again over a night, over a month, I'll do it. That's the stock market. The stock market is much closer to poker than it is to than any other game. And I think that's what's the important thing to know. And what the hell was the question? Fannie Mae. Fannie Mae has been sort of like a 27-card stud poker game, over 12 years. Cards keep getting turned over, like we're not doing so well in Houston, and this is 10 or 12 years ago, and with these 5% downs that a lot of people had in mortgages, and people moved there for jobs, and they brought their spouse along there, and the job left, they had no ties to those communities, and they left, or in Oklahoma or in Alaska. So when that card turned over, it was kind of ugly. And then they were losing $1 million a day. That was easy to remember. That wasn't too pleasant. And what they finally figured out was we have a very good business. We're extremely low cost. And if we can match our liabilities and our assets, make a very small spread, but we have very low costs, we can have a pretty good business. And then a card would come over like real estate prices started to go down in California. They started to go down in the Northeast. So then you had to say, well, I better keep checking to see what foreclosures going to be like. And you must own, that doesn't own any Fannie Mae. But so anyway, so all these things, if you keep watching the story, every year you get a chance to buy this again. Something will come up. People were worried that rates were going to go down. So the stock went down because rates were going down. And then now interest rates gone up, the stock's going down because interest rates gone up. And Freddie Mac and Fannie Mae are still doing great. And I think they're going to be terrific stocks. I mean, they're not going to quadruple, but I think they're about 25% undervalued now, and I think it'd be good stocks to own for 5 years.
It's my pleasure, Mr. Lynch, to present you with a Press Club mug and a certificate of appreciation before I ask the final question.
Uh-oh. Try to drink coffee.
Here's a fella has a problem. He says, well, if the real secret of your success is following your daughters to the shopping mall for stock tips, what do we bachelors do?
Well, I think on the weekend, I think one of the reasons people get so depressed is they get away from children. On the weekend, they read all these magazines, they read the newspapers, and they can become economists, and they get so depressed. I mean, they're bullish if they take their lunch to work on Monday, And I think you need to rent a 12-year-old on the weekend, just to, because they don't know about the problem of the ozone layer disappearing and all the problems of, all these terrible things that we think about all the time. You get so depressed about, and how second basemen and shortstops that are getting paid $4 million and they can't throw it to first base on a bounce, So I think you need to find a 12-year-old and rent them for the weekend, and follow this boy or girl around and see where they're shopping. And our kids love Body Shop, and I bought it, and I think it's going to be a good stock. And our oldest daughter, Mary, liked Ann Taylor, and she had to dress up to go to work she was working in the summer at a consulting firm, and she thought Ann Taylor's prices were good and the quality was good, and it was a great stock tick. And my wife, Carolyn, who was 2 until we had these 3 kids, she's an extremely good shopper, and she almost got a black belt in shopping. She didn't fit, because of the children, she didn't quite finish that, but she's a very good shopper, and she's given me some great tips too. So I think you either have to use your spouse, or you have to go out on your own. I had this biggest position in my fund one time was Hanes, which owned Legs, and was a huge stock, and it was bought eventually by Consolidated Foods, and it was the best division of Consolidated Foods. But it was my biggest position, and they had a monopoly on this Legs, and Legs is a really big hit. I knew somebody would come along with a new product, and it was Kaiser Roth introduced No Nonsense. And I was worried that this thing was better, and I couldn't quite figure out what was going on. So I went to the supermarket, and I bought 62 pairs of No Nonsense, different colors, different shapes. They must have wondered what kind of house I had home when I was going back. But I brought it in, I brought it to the office, and I passed out to anybody, male or female, anybody wanted these things, just take them home and tell me how it is. And they came back in about 3 weeks, and they said, it's not as good. And that's what research is. That's all it was. And I held on to Hanes, and the stock was a huge stock. So that's what it's about. Thank you.
Thank you, Mr. Lynch, and thank you all for being with us.
All right. I apologize.
Oh, yeah, no.
Great book.
Oh, thanks so much.
Thanks again. Great one.